All right, let's get right into it. The housing market right now, it feels pretty impossible for a lot of people. And whenever things get tough, these creative solutions start popping up. The latest one making the rounds is the 50-year mortgage. It's pitched as this incredible lifeline, a way to finally get your foot in the door of homeownership. But is that what it really is? So that's the big question we're going to tackle here. Is this thing a secret weapon, a hack to beat the system, or is it actually a financial trap, just dressed up to look like a helping hand? To figure that out, we've got to look at why it's so tempting in the first place, and then we need to look at the shocking math hiding just beneath the surface. So first up, let's talk about the appeal. Why on earth would anyone sign up for a loan that will outlive their pet, their car, and maybe even their career? Well, the whole sales pitch boils down to one single, very powerful word: affordability. So what exactly are we talking about here? A 50-year mortgage is, well, exactly what it sounds like. It's a loan you pay back over 5 decades. That's 600 separate monthly payments. Now, just to put that into perspective, if you get one of these loans when you're 30 years old, you'll be writing your very last check at age 80. Yeah, 80. And here it is. This is the bait. This is the shiny object they dangle in front of you. Let's say you're looking at a $400,000 loan. With the 50-year option, your monthly payment is about $189 lower than a normal 30-year mortgage. And if you are stretching every single dollar just to make ends meet, that $189 a month feels huge. It feels like the difference between getting a house and getting rejected. And that lower payment does something really important behind the scenes. It helps you get past what we'll call the DTI bouncer. Your debt-to-income ratio is what lenders use to decide if you can be trusted with a loan. If your monthly debts are too high for your income, the bouncer at the club says, nope, you're not getting in. But by making that mortgage payment look smaller, the 50-year loan can kind of sneak you past the velvet rope into a house you might not otherwise qualify for. Okay, so that was the sales pitch. It seems kind of logical, doesn't it? A lower payment to get in the door. But now we're going to pull back the curtain. We're going to look at how these loans really work. And this, my friends, is where that beautiful promise starts to completely crumble. To really get this, you have to understand a word that sounds complicated, but is actually simple: amortization. All it means is the process of paying off a loan. But here's the catch, the really crucial part. Mortgages are front-loaded with interest. That means for the first several years, almost all of your money goes straight into the bank's pocket as profit. Only a tiny, tiny fraction actually goes to paying down the money you borrowed. So let's make this super real. We'll use that same $400,000 loan example, and we're going to ask one simple question. When you make your very first payment on that new house, where does your money actually go? The answer is, well, it's pretty staggering. Just look at this breakdown. With a normal 30-year loan, your first payment of about $2,500 pays down your debt by $361. Okay, not amazing, but you're making progress. Now, look at the 50-year loan. Of your $2,339 payment, a whopping $2,333 is pure interest for the bank. And the amount that actually goes towards your $400,000 home? $5.67. Let that sink in for a second. $5.67. No, that is not a typo. You've made your first big payment on your dream home, and you've paid off less than the price of a latte. You're not really a homeowner at this point. You are essentially just renting money from the bank at an insane price. And that one single, frankly insulting number, 567, is the key. It's the little crack that opens up a whole lifetime of devastating financial traps. So let's walk through exactly what those traps look like. The first and most brutal trap is just the total cost. It's just mind-blowing. Over 30 years, that standard loan costs you about $500,000 in interest on top of the loan. That's a lot. But the 50-year loan, you pay the bank over $1 million in interest. Just let that wash over you. To save $189 a month, you end up handing the bank an extra $500,000 in interest. This has a direct effect on your ability to build what really matters: equity. Now, equity is just the part of your home you actually own. It's the home's value minus what you still owe the bank. And make no mistake, it is the single most powerful wealth-building engine in all of real estate. And the difference in how fast you build that wealth, it's not even close. After making payments for 10 full years on a 30-year loan, you've built over $52,000 in actual wealth for yourself. Not bad. On the 50-year loan, after an entire decade of payments, you own just $1,170 of your home. You're building equity in what feels like geological time. Because you're building almost no equity, you are walking straight into the underwater trap. All it takes is a small dip in the housing market, and suddenly your home is worth less than what you own on it. When that happens, you are stuck completely. You can't sell it without bringing cash to the closing. You can't move for a better job. You can't refinance. Your home literally becomes a prison. And then there's the cold, hard reality of that timeline. Let's just play it out. You get this loan at age 30. You work your whole life. You hit 65, the typical retirement age, and you still have 15 years of payments to go. Think about it. You're 75 years old, trying to live on a fixed income, and you are still writing a check for over $2,300 every single month. How is that supposed to work? And as if all that wasn't bad enough, these super risky loans are often bundled with other nasty surprises. You might find interest-only periods, where for years your loan balance doesn't go down by a single penny. Or worse, a massive balloon payment, where a huge chunk of the loan is suddenly due all at once. They're just designed to be riskier, period. So, after seeing the pretty sales pitch and then seeing the absolutely brutal reality, what's the final verdict? And maybe more importantly, if this isn't the way to go, what is? Let's just be perfectly clear. With a 50-year mortgage, you're not really buying a house. You are signing up to be a permanent tenant, and your landlord is the bank. It's a trade that gives you a tiny bit of relief today in exchange for a lifetime of debt that transfers a staggering amount of your potential wealth directly into your lender's pockets. But look, the good news is there are so many smarter, safer ways to get there. It might mean adjusting your dream a little bit and starting with a smaller home. It might mean being patient and saving for a bigger down payment. You can look into fantastic government programs like FHA or VA loans. You could even house hack and rent out a room. Any of these options will put you on a path to building real wealth, not a 600 payment trap. So that brings us to the final question, and this one is for you to think about. Now that you know the truth behind the math, what is one small step you can take today, whether it's setting up an automatic savings transfer or just researching FHA loans in your area, to put yourself on the path to building real, lasting wealth instead of a lifetime of debt?